I think we had stopped with this in the last session. Do you have any difficulty up till this? Have you gone through this? Whatever we have done up till now?
Sir, I think we have to start with recognition. We finished all the elements.
Okay.
Elements of financial statement.
Okay. Have you gone through all those things?
Yes, sir.
Any difficulty that you found?
Sir?
Did you find anything difficult?
No, sir. I can understand everything. It is clear, sir.
Okay. Let us now come to recognition of the elements and derecognition of elements. Now, whenever we are doing any topic in financial reporting, whether it is non-current assets or whether it is current liabilities or current assets, we will be always going in a particular procedure or a particular method of discussion. And that is, we first start with the recognition or derecognition of the item. Even if it is an income or an expense, the first thing that we look for is whether we are going to recognize the item or not. So recognition is the starting point of everything. And derecognition is the ending point of everything. Now, what do we mean by the concept recognition? Recognition means that we are going to include it in the financial statements. The meaning of recognition means, if I say that I'm going to recognize this in the financial statement, it means that I'm going to include it in the financial statements. So for including anything in the financial statements, there are certain rules and regulations. So the first thing that we have to know is that items are only recognized in the financial statements if they meet the definitions of the 5 elements that we have discussed in the last session. So when we are discussing, we discussed assets, liabilities, equity, income, and expenses. Now, if any of the items that we have are going to be as per the definitions or satisfying any of the definitions which we have learned of the 5 elements of accounts, the financial statements, then only it will be recognized in the financial statements. Then only it will be included in the financial statements. If it is not satisfying any of those conditions, then it will not be included in the set of financial statements. However, elements are recognized if recognition provides the users with useful financial information. So not only that they should be satisfying one of the conditions or one of the definitions of the 5 elements, but they should be useful for the users of the financial statement. That means an investor or a creditor or a bank or a financial institution or the government or the employees, they should be having some use of the data. In other words, recognition must provide relevant information and a faithful representation of the asset or liability, and resulting in income, expenses, or equity movements. Recognition might not provide relevant information if there is uncertainty over the existence of the element, or if there is a low probability of an inflow or outflow of cash. Cash meaning economic resources. So, 2 things are there. When recognition will not happen, if it is not providing relevant information, and if it is uncertain, that means we do not know whether it will happen or not happen, and there is a low probability or a very low probability that there will be either an inflow of cash or an outflow of cash. The simple example is a court case pending for several years against the company. So if customer of a company has filed a case against the company, saying that the product which is used, given by the company, has caused him harm and he has suffered because of the, then in that case, the case is going on for several years. There may be a possibility that we may have to pay compensation, we may have to pay damages. But there is uncertainty over the decision. It has been pending going on for several years. Uncertainty is there, whether there will be an obligation or not. Plus, the probability that we will end up paying for damages is very low. Then in that case, it is better not to show the item in the financial statement, not to recognize a statement item in the financial statement. If you want, you can show it as a note to the financial statements, but not recognize it in the financial statements. That is one of the reasons why we have certain items called as contingent liabilities or contingent assets, which are not shown in the financial statements. Contingent liabilities are those liabilities which may or may not arise. So there is uncertainty whether it will arise or it will not arise. Secondly, even if it arises, what is the probability that we may end up paying something? That also is a very low probability. Then in that case, we say that contingent liabilities will not appear in the financial statements. It will come if you want to disclose it to the investors or the readers of the financial statements or the users of the financial statements. You can include it as a part of your notes to financial statements, explanatory notes. Okay, so that is what is the recognition part. Now, a recognition of an element might not provide a faithful representation if there is a very high degree of measurement uncertainty. Judgment is required in deciding if recognition of an element is appropriate or not. This is why specific recognition criteria vary from one IFRS standard to another. Now, the last paragraph is important. If an asset or liability is not recognized in the financial statements, disclosures may be required to ensure users of financial statements fully understand the reporting entities, economic transactions, and the implications that these may have on the future earnings or the future cash flows. So I'm not going to recognize a liability, a contingent liability, because it is uncertain. And we do not know whether we will be ending up paying any obligation or not. We do not know whether there will be any outflow of resources, economic resources or not. So that is why I don't show the contingent liability in the financial statements. It is not recognized. But the thing is that even if I don't recognize that, if I feel that it is important, that my readers and users of the financial statements should be able to know what is happening in the company. And in case in future, the case goes against the company, that there may be an outflow of cash. That is what is to be informed to the readers of the financial statements. In that case, you will have to include that as a note to the financial statements. Financial position approach to recognition. It can be seen therefore that income is an increase in an asset or decrease in a liability. Expenses are an increase in a liability or a decrease in an asset. As income and expenses are therefore recognized on the basis of changes in assets and liabilities, this is known as a financial position approach to recognition. Now, what about derecognition? Just like recognition means including an item in the statement of financial in the statement of financial position or statement of profit or loss. Derecognition means removing that particular item from the financial statements. So derecognition involves removal of the items from the financial statements. This normally occurs when the entity loses control of the asset, not ownership of the asset, but control of the asset, or has no present obligation for the liability. Because we defined the liability as a present obligation arising out of past events. So if there is no present liability obligation, then it is not a liability. Okay. If there is no control over the asset, it is not our own asset. Accounting for derecognition should faithfully represent the changes in the entity's net assets, as well as any assets or liabilities which are retained. So that means if there is any asset that we have sold during the year and we have lost control of that asset, in that case, it has to be removed from the financial statements and the effect of that removal should be shown also. This is achieved by three things. First, derecognizing any transferred, expired or consumed component. And the word is and, that means there are three conditions. They are not optional, they are compulsory. So derecognizing any transferred, expired or consumed component, that means removal of that particular component from the financial statements. Second, recognizing a gain or loss on the above. So suppose you are having a building having a carrying amount of $20,000. It has been sold for $18,000. So 2,000 loss has to be shown. Same way, a 20,000 asset has been shown as sold for 25,000. So the 5,000 gain has to be shown in the financial statements. And recognizing any retained component, which means that suppose I have sold the machine, but a component of the machine has been kept back by the company because it's good, it can be utilized, it can be used for another machinery. So then the component will be valued separately and recognized in the financial statements. So three things that you have to do. Remove the item from the financial statements, that is derecognizing. Second, profit or loss on the sale of that item should be accounted for. And third, if you have retained any component of that asset, then you have to recognize that component separately in the financial statements. Sometimes an entity might appear to have transferred an asset or liability. However, derecognition would not be appropriate if exposure to variations in the element's economic benefits is retained. Now, for example, they have given of derecognition. An entity sells a building for $2 million and retains the right to buy it back for $3 million in 5 years' time. So it is giving a declaration that we are selling the asset, but we have the right to buy it back for $3 million. Okay, but time period is also given 5 years' time. On the date of sale, the building had a fair value of $7 million. Property prices are expected to rise. Now, the first thing is that you have sold the building, you have lost ownership of the building. Because when you sell a building, you lose the legal title. You have transferred the legal title to the customer. But in international accounts, I told you, we are not concerned with ownership, we are concerned with control. So your building has been sold, but you have retained the control of that by including a point saying that we retain the right to buy it back after 5 years or within 5 years for $3 million. So till 5 years, I will show it in my balance sheet. The entity will show it in its balance sheet, even though it has sold the asset. So selling of the asset has got nothing to do with recognition and derecognition. Have you lost the control of the asset? That is what is to be said. If you have lost the control of the asset, then it is not your asset, it should be derecognized. But since you have retained the right to buy it back within the next 5 years, that means you still want to control the use of the asset. At the date of sale, the building had a fair value of $7 million, property prices are expected to rise. So tomorrow, if you want to buy back, as of now, the value of the property is $7 million. And they have said that property prices are expected to increase. So within 5 years, when you want to buy back, that $7 million will become $9 million. But you have got the right to buy it back for $3 million because that is the agreement that you have made. So whatever is the price declared in the agreement, that will be full and final. So even if the value of the building goes up to $10 million, you have got the right to purchase it back for $3 million. So the entity will not de-recognize the building for 5 years. The entity does not de-recognize the building from its statement of financial position because it has not lost control over the building. Because its ability to buy the building back for substantially less than the fair value enables it to benefit from future price rise. So how do we record for this? We record for this as a loan liability. So the entity will record this as loan received because they have sold and received cash. So debit cash, $2 million, credit loan, $2 million. So how this is going to be accounted for in the books of accounts? What we will do? We will debit cash account. To the extent of $2 million. And we will credit loan account to the extent of $2 million. Debit cash, credit loan to the extent of $2 million. Now, suppose you decide to buy back the building. Now here, nowhere you have received that, you have shown that building is going out. Even though you have sold the building, you are not showing that building is going out. You are not saying debit cash and credit building. You are saying debit cash and credit loan. Suppose you are going to purchase the building by paying 3 lakhs. Then cash is going out 3 lakhs. But again, you are not going to show the building coming back. But you will show that loan has been repaid. So you will debit the loan, $2 million. You will debit interest with $1 million. And you will credit cash because cash is going out of the business to the extent of $3 million. So you can see that neither building has gone out of the business, nor a building has come into the business. This building is always there. It is never removed from the balance sheet at all. So, though I have sold the building, though the company has sold the building, it is not taken out from the balance sheet because I have not credited the building anywhere. I have debited cash and credited loan. I have not credited building. So building is still there with me. So when I buy back, again, I don't have to show building because building is already there. It never went out of my business. Loan account will get cancelled. So earlier loan was credited. Now loan will be debited. So loan debit, loan credit will cancel. But I'm paying 1 million more. How will I account for it? Interest expense. So it will be shown as interest expense. Okay. In some books, instead of writing loan, they write it as financial liability. So they don't use the word loan over here. They use the word financial liability. So in that case, here also you use the word financial liability. So that completes my chapter number 5. Sorry, chapter number 6. Anything that you have not understood? Anything that you want to clarify? All points clear?
I have understood, sir.
Okay.
Sir, I had a small doubt. In derecognition, what do you mean by recognizing any retained component?
Retained component is what I told you. Like for example, you are selling a machinery. But when you're selling a machinery, a part of the machinery, you find that it is good, it is in working condition. So you want to keep it back so that it can be used for something else or a new machinery. For example, you are selling your car, or inside your car, you are having your deck, music deck. So you find that the music deck is working. So you remove the music deck and you sell the car. That music deck can be installed in your new car, isn't it? So in that case, that component that you have removed out, which is not sold, that will be shown separately in the balance sheet. Okay?
Yes, sir. Understood.
That completes chapter number 6. We come now to chapter number 7. These are basic topics which you need to understand financial reporting. So that is why I'm not going in the original order, that is chapter 1, 2, 3, like that. First, you have to know what are the statements, financial statements, what are the formats of the financial statements. Then you have to know the regulatory and conceptual framework. And now we come to measurement as a conceptual framework. Okay. Now, in the topic of measurement, we will learn the different methods of measurement. We will learn that there are different ways in which we can value the assets, liabilities. So we call them as measurement basis. There are a number of measurement bases mentioned in the International Accounting Standard Board conceptual framework for financial reporting. The first one is historical cost. What do we mean by historical cost? The historical cost means the cost at which we originally purchased the asset. Whenever we purchase the asset, 2 years back, 3 years back, on that particular date, what was the cost? So that is historical cost. Second is current cost, the cash that would have to be paid to replace the asset. So at the side, I have written over there replacement cost. So you can also write over there at the side replacement cost. Current cost is also called as replacement cost. That means, suppose I have to buy an asset which is as old as mine. Then what is the replacement cost? Now I may have purchased the asset. See, it is like this. I may have purchased the asset and paid a cost of $10,000. 2 years have passed, so I must have charged depreciation for first year, $1,000. 9,000 balance. Second year, I must have depreciated by another $1,000. So $8,000. So now the carrying amount of the asset is $8,000. Now I see that if I have to replace this asset, what is the current replacement cost? So current replacement cost, first I'll go to the market and find out what is market value. That if I'm going to purchase today, what is the price? So you come to know that today's price or today's cost is $12,000. But this is for a new asset, but my asset is 2 years old. So I will depreciate this by 2 years. First year, 1,200, assuming 10%. So it will be 10,800. Okay. Then second year, again depreciation, 1,200. So it will be 9,600. So this is your replacement cost. So if you have to replace the asset today, the actual replacement cost would have been 9,600. Okay. So that is your current cost or replacement cost. Fair value. Fair value is market value, also called as arm's length price. I told you this before also, arm's length price. That is a normal selling price which happens between a buyer and a seller who are total strangers to each other, who don't know each other. So I give you the example also that when we are talking about fair value, arm's length price means what? That suppose I'm publishing a book on financial reporting. I've written a book on financial reporting, I'm publishing it, and I'm selling it in the market for say 1,000 rupees. Now you come to know about it and you say, sir, I want to purchase your financial reporting book. So I tell you, fine. Since you have been my student, I'll give you a discount of 300 rupees. So instead of 1,000, you pay me 700. Now 700 is not the fair value. Is it the fair value? No, it is not the fair value. Because the transaction is not taking place between two strangers. You are my student, and therefore I am giving you a discount. To an outsider, I will not give discount. To an unknown person, I will not give a discount. To an unknown person, I will sell it for 1,000 rupees. So 1,000 rupees is the fair value, not 700. 700 is a selling price which is given to a related party. We call it as related party transactions. Okay. So fair value is the market value or the price at arm's length disposal. Last one is value in use. Value in use means first we'll try to find out what are the future cash flows. Those future cash flows will discount it. We'll discount it and find out what is the present value of those cash flows. So it is nothing but present value. Value in use means what? Present value of future cash flows. Present value of future cash flows. Or discounted value of future cash flows. You can call it. Current cost is normally used only as an alternative to historical cost, taking into account inflation. This will be investigated further within this chapter. But I've told you this calculation simply I told you. See, current cost is normally used only as an alternative to historical cost, taking into account inflation. So my original cost of the asset was 10,000, but when I went to purchase it now, because of inflation, it was 12,000. Because of inflation, the increase in the price. When I purchased it 2 years back, it was costing 10,000. 2 years later, the cost has increased, inflation. It has become 12,000. So that 12,000, I will then discount it for 2 years because I was holding the asset for 2 years. So had I purchased for 12,000, what would be the depreciated value? 9,006. So like that, I will be taking the calculations. Not, it is not, yeah. Point is clear? Okay. Some items such as revalued assets or investments may be revalued to fair value, being the realizable value. Present value may be used in respect of items with cash flows receivable or payable in a future period. That means if you are told that you are going to receive, and let us say you have given a loan to an employee's loan, which is receivable after 2 years. So you may need to calculate what is the present value of that. Discount it for 2 years and find out what is the present value. So then they have given you all the definitions explained. What is the historical cost? What is the advantage of historical cost and all that? Not necessary to go into the depth of this. We just give one reading and forget it because we are concerned with the concept. We are concerned with what is historical cost. Okay. So just give one reading to it because you have to understand what advantages and disadvantages may be there for historical cost. So basically, historical costing is the cost at which we have originally purchased the asset. So let us take an example based on this. Company A acquires a new machine in 20x4. This machine cost $50,000 and it has an estimated useful life of 10 years. Company B acquires an identical 1-year-old machine in 20x5. The cost of the machine is 48,000 and it has an estimated useful life of 9 years. Depreciation charges on straight line basis, nil residual value are as follows. Company A had purchased the asset for 50,000 and that asset had 10 years value. So 50,000 divided by 10, we are charging 5,000 as depreciation. Company B has purchased the asset in the subsequent year for 48,000. For 48,000 at a lower price. And that asset has got a 9-year life. That asset is going to be depreciated by 5,330. Now, what do you say? You say that, sir, it is very odd. The reason being that an asset which was purchased for 50,000 is having less depreciation than an asset which is purchased at 48,000. Correct now? You purchase, company A has purchased it for 50,000. Company B has purchased it for 48,000. Now, in the second year, when two companies' profit and loss is checked, Company A will be showing 5,000 depreciation. Company B will be showing 4,000 or 5,333 depreciation. What will be the impression to the reader of the financial statement? Impression to the reader of the financial statement will be that company B has purchased a costlier machine. That is why depreciation is more. But the real fact is, company B has actually purchased a lower cost machine, or the price of the machine was lower when company purchased. But in spite of that, the depreciation is higher. So this is a paradox. This is a paradox. It's a contradictory statement that in spite of having a lower value, I'm having higher depreciation. So that is one of the limitations of your historical cost. Now let us see the carrying amounts. Let us see the carrying amounts also. For company A, 50,000 is the cost. 5,000 into 2 years. 5,000 into 2 years, 10,000. So 50 minus 10, 40,000. Company B, 48,000 minus 5,333. The value is 42,667. So without any knowledge, when a reader of a financial statement, a user of a financial statement is comparing A with company B, what does he find? Company A assets are 40,000. Company B assets are 42,667. So again, the impression is what? Company B's assets are having a higher value. But is it actually having a higher value? No. It's actually having a lower value, 48,000. Right? So both the companies are using identical machines in 2000 XY. But the statement of profit or loss will show quite different profit figures because of adherence to historical cost. The two companies may have made the same profit, but because of difference in depreciation, the profits of the two companies are different. That is what we call as a paradox. Okay. So that is your limitation of historical cost. Okay. Now you have to know this net realizable value. Don't have to know anything else. Your net realizable value and economic value. Economic value is nothing but value in use. And what is value in use? Present value of future cash flows. Net realizable value, very important because it will come in many places. Net realizable value, also known as fair value less cost to sell. It is not only fair value, it is fair value, market value, minus the cost to sell. So suppose the fair value, the market value of an asset is $10,000. But you have to make some modifications to sell the asset, costing $1,000. So what is NRV? 10,000 minus 1,000, $9,000. That is the NRV. So NRV is actually what? Fair value. Fair value means market value. Market value minus the cost to sell. Whatever cost you are going to incur to sell the asset, that will be deducted from the market value. And that will become your net realizable value. Clear? Here is an example where you will be finding all the methods here. Company owns a machine which is purchased 4 years ago for $100,000. The accumulated depreciation on the machine to date is $40,000. Machine could be sold to another manufacturer for $50,000, but there would be dismantling cost of $5,000. To replace the machine with a new version would cost $110,000. The cash flows from the existing machine are estimated to be $25,000 for the next 2 years, followed by 20,000 per year for the remaining 4 years. The relevant discount rate for the company is 10%, and the discount rates are given to you in the question. Normally, they are given to you. If not, you have to refer to the annuity table. And from there, you will have to calculate the discounting rate. And you must have done financial management. So you are aware of how to refer to the annuity table and get the values from there. Okay. You have to take it up to 3 decimals. So year 1, they have given, year 2, they have given, and years 3 to 6, they have given. You are asked to calculate the following values for the machine. What first is the historical cost? Historical cost means the cost at which you have purchased the asset. You have purchased the asset 4 years ago for $100,000. So that is your historical cost. But they have also said that there would be dismantling cost of 5,000. So historical cost will be 1 lakh only. Dismantling cost is not to be taken now. Cost minus the depreciation 40,000. So your net historical cost is 60,000. What is net realizable value? Net realizable value is selling price minus cost to sell. Selling price. What is the selling price? If we are going to sell the machine could be sold to another manufacturer for $50,000. That is the selling price. And there would be dismantling cost also 5,000. So that is cost to sell. So 50,000 minus 5,000. 50,000 minus 5,000. 45,000 is your NRP. Okay. Third is replacement cost. Replacement cost for new asset is $110,000, which is the value here that they have given. New version would cost $110,000. But now the asset is 4 years old. So that $110,000 you have to depreciate for 4 years. So I will take $110,000 into 1 by 10 because life of the asset is 10 years. So divide by 10, so 11,000. 11,000 into 4 years depreciation, so multiply by 4. So total depreciation for the 4 years is 44,000. 110 minus 44, 66,000. Economic value. The fourth one is economic value. Economic value is present value of future cash flows. Discounting factors are given to you. And the future cash flow is given to you as 25,000 for the next 2 years and 20,000 for the remaining 4 years. So first 25,000 I will multiply by 0.909. Second 25,000 I will multiply by 0.826. And then it is 20,000 for the remaining 4 years. So that 20,000 will get multiplied by 2.619. Okay. So when I multiply all this, I take the total, and this total 95,755 becomes my value in use or economic value. Okay, either of the two, economic value, or it is also called as value in use. Okay. Coming to monetary items and non-monetary items. I think this I discussed in the class in the last session of AFM. Monetary and non-monetary items. Monetary items are those items whose amounts are fixed. They don't change in value. And examples they are given as cash, receivables, payables, loan capital, etc. Remember the examples. You'll know what is a monetary item. Suppose you are having 10 rupee note in your pocket. Okay. Tomorrow the government says there is a 10% inflation. So when you put your hand in the pocket, will you find 11 rupees in the pocket? No, you will find 10 rupees. So cash of 10 rupees will remain 10 rupees. Let us say that you have taken a loan from the bank of 1 lakh rupees. And next year there is inflation. So will the bank tell you, now you are not supposed to repay 1 lakh, you are supposed to repay 1,10,000. Will the bank tell you that? No. Bank will not tell you that, because amount of loan taken by you does not change irrespective of the inflation. Suppose I give you 100 rupees. Tomorrow there is 10% inflation. Will I say that you have to return to me 110 rupees? Because you have taken 110 from me? No, you have taken 100 from me. You will return 100 to me. I have sold goods to you of $40,000. If there is inflation of 10%, will I ask you to repay $44,000? No. So these amounts are not going to change in value, whatever may happen. These are monetary items. Non-monetary items are likely to change in value. Land, for example. You purchase land for $5 lakh. But after 1 year, the value of the land increases to 6 lakhs. You will have to revalue the land. Right? So value of the land has increased to 6 lakhs. So non-monetary items, value will keep on changing. Stock, for example. What is the principle of valuation of stock? All these years you were carrying stock at cost, but suddenly this year you find that market price is below cost. What is the principle of valuation? Cost or market price, whichever is lower. So every year you have been valuing stock at cost. And the same stock was there. Last year also the same stock was there. It was not sold. $40,000 was the value of the stock. This year you brought it. Okay. And in this year you found that market prices decreased to $35,000. So you will revalue to $35,000. So value has changed now. Inventory value has changed from last year 40,000 to current year 35,000. So non-monetary items value can change. Monetary items value cannot change. Okay. So non-monetary items include such assets as inventory, non-current assets, that is fixed assets like land, building, etc. Retaining the historical cost concept requires that holders of non-monetary assets are assumed neither to gain nor to lose purchasing power by reason only of changes in the purchasing power. The owners of a company's equity capital have the residual claim on the net monetary and non-monetary assets. The equity interest is therefore neither a monetary nor a non-monetary item. So this last line you underline. Equity is neither monetary nor non-monetary. MCQ it may come. Equity is neither a monetary item nor a non-monetary item. I think that's it for this particular topic. You can go through all the MCQs which are there, test your understanding, and if you have any difficulty, you can tell me. Okay. So chapter number 7 is also over. So 1, 6, and 7 are over. So 1, 6, and 7. These 3 chapters are over for you. Now I am starting with the main part. That is, I'm starting with chapter 2, tangible non-current assets. Tangible non-current assets. The first thing that you have to know here is the accounting standard number. The accounting standard number is IAS 16. Most important accounting standard number. IAS 16, that is International Accounting Standard. Not Indian Accounting Standard. I stands for International. International Accounting Standard 16. which deals with property, plant and equipment, that is PPE. Now, property, plant and equipment are tangible assets held by an entity for more than one accounting period. And what is important here is for use in the production or supply of goods or services, for rental to others, or for administrative purpose. So, IAS 16 property, plant and equipment will include land, building, machinery, equipment, furniture, motor vehicles. Okay, everything that is a fixed asset will be included in property, plant and equipment. Now listen to what I'm saying. Land, building, machinery, equipment, plant, everything will be included under property, plant and equipment, including furniture, etc. All of them are considered together as PPE, that is property, plant and equipment. But all of them are not covered by IAS 16. Until and unless they satisfy a very important condition. And that condition is that these assets are held by the entity for being used in the production of goods or provision of services. Only if it is used in the production, only if it is used by the business for its purpose, then it will come under IAS 16. Simply because it is property, plant and equipment, it is not going to come under IAS 16. Because certain property, plant and equipment will come under IAS 40. And certain property, plant and equipment will come under IFRS 5. So which PPE will come under IAS 16? That PPE which is used for business purpose. That PPE which is used for producing goods or for rendering services by the entity, and which will result in cash flows to the entity. It may be for rental purpose also. Okay. Now, as I told you, every item we will discuss in a particular method. We will discuss in a particular process. What is the process? I told you we start with the recognition. We start with the recognition. Then we move on to initial measurement. Initial measurement, once you recognize, means what? Once you are determined to put it into your financial statement, include it in your financial statement, then we'll say at what price we are going to show, at what cost we are going to show. So that is the initial measurement of the item. Then at the end of the year, on the reporting date is December 31st. At the end of the year, on the reporting date, that is December 31st, the next will be called a subsequent measurement. So you have initial recognition, then you have initial measurement, then you have subsequent measurement. After subsequent measurement, you may go for depreciation. You may go for impairment calculation. You may go for revaluation. Okay, I'm telling you all these are the steps. And after doing this for several years together, the last ending part is derecognition. So anything that you are discussing, you have to frame your mind in this way only. You have to follow this procedure. First thing is recognition. Will I show it in the first question that comes? Will I show it in the financial statements? Then only I will think about other steps. If I'm not going to show it in the financial statements, why break my head? If I'm going to show it like something like contingent liabilities, I'm not going to show it in the financial statements. Why will I bother further? I'll just put it in the notes. If it is going to be recognized, if it is going to come in the financial statement, then I will think where I will show, whether I will show as fixed asset, as current asset, as long-term liabilities, short-term liabilities, where I will show. So that where I will show comes only if I'm going to show. So the first thing is recognition. Are you going to recognize the item in the financial statement? So what is the criteria for that? The two criteria. Point number one, it is probable that future economic benefits associated with that asset will flow to the entity. That means entity will get the benefit, the company will get the benefit of future cash flows arising from that asset. Say, for example, some property is there which you have let out on rental basis. So what you are going to receive in future? Rent. Is it going to be beneficial? Yes, of course. So future cash flows are going to be beneficial for the company. And second point. So the word is and. I always circle that word because it means that both have to be satisfied. If anyone is not satisfied, it cannot be recognized. Both have to be satisfied. So first, it should be giving some economic benefits in future to the company. Second, the cost of the asset can be measured reliably. If you are unable to measure the cost, even if it is going to give future benefits, it will not be recognized. Okay, so recognition part of property, plant and equipment. Now you can see next step is what? Initial measure. That is when I buy the asset and I have decided that I'm going to show this in the balance sheet. Obvious question is, what value am I going to show? So now what comprises my initial measurement? They say that an item of plant, property, plant and equipment should initially be measured at cost. Initially be measured at cost. No second option. Only one option. That is, we are going to measure it at cost. Now, what includes cost? What all items will be included in cost? That breakup is to be known by us. What constitutes cost? First, purchase price. The price that you have paid for purchasing the asset. Second, all the direct cost that is included for bringing the asset up to the factory, up to the office, and putting it into workable condition. So transportation cost, installation cost. Suppose you have painted the asset, then the painting cost. Suppose you have made some alterations to the asset, then the alteration cost. So all the direct expenses which are involved for bringing the asset and putting it into workable condition. First. Second, include in this initial cost capital costs such as the cost of site preparation, delivery cost, installation cost, borrowing cost. But borrowing cost I have underlined because we are going to do this at a later stage. Because there are some restrictions on the borrowing cost. Borrowing cost means interest. So there are some restrictions on interest that we are going to see later on. So cost of site preparation. Now you have purchased machinery, a huge machinery, and you are going to install it in your factory. So production manager tells you that, sir, this machinery is going to have a lot of vibrations. And if you install it without any support, the ground is going to shake and that entire factory will start shaking with the vibrations of that machine. So he suggests that before installation of the machine, you prepare a small platform for that machine, concrete platform, a cemented platform. Now you must have seen where these generators are there, diesel generators are there, DGs are put up. They are not installed into the ground. There is a small concrete platform constructed. On that, the DGs are installed. Why? Because there may be the vibrations. So to absorb that vibration, you prepare a concrete block, concrete platform. That is called site preparation. Even though you are constructing the concrete block on inside the building, inside the factory building, it is not a part of the building. It is not going to be added to the cost of building. It will be added to the cost of machinery, because that is site preparation cost. Delivery cost, transportation cost, installation cost, borrowing cost, interest paid for purchase or construction of that asset, subject to certain restrictions. Okay, all this will be added to the initial cost. What is not going to be added? Fuel cost is not going to be added. Training of employees, how to work the machine, not going to be added. Warranty cost, not going to be added. They will be shown in the profit and loss account as expenses. So we say that these items are going to be expensed. Expense means that they will be shown in the profit and loss as expense. So what will be included? Purchase price and all direct expenses which are incurred for bringing the asset and putting it into workable condition. Third thing that is going to be included is the dismantling cost. 20 years afterwards, you are going to remove the machine. But the machine has been installed in the ground now. So when you are removing the machine, there will be some dismantling cost. You have to remove very carefully. Suppose you are having an installation of a nuclear plant. That nuclear plant, if you don't remove with care, it will create a huge disaster, which will harm the environment, the air, the water, the people. You must have heard that there was some Bhopal gas tragedy in Madhya Pradesh. So that is nothing but a huge disaster. So whenever you are dismantling anything, you have to do it carefully. Even a simple thing like your LPG cylinders at home, you have to ensure that when you are disconnecting, you have to be very careful. Otherwise, it will blow in your face. So dismantling cost, which is to be done at the end of the life of the asset. I say, sir, but why to add it to the cost of the asset? I will not add the dismantling cost. I will add the present value of the dismantling cost. So 40,000 is to be paid as dismantling cost after 20 years. What is the value of that 40,000 today? Find out present value. And that present value I will show in two places. First place, I will add it to the cost of the asset in the balance sheet. And second place, I will show it in the liability side. Why in the liability? Because 20 years later, I have to pay that amount. So it is a long-term liability. Okay. So dismantling cost, see what I've underlined. Present value of this cost should be capitalized with an equivalent liability setup. The discount on this liability would then be unwound over the period until the dismantling costs are paid. So first year May, what you are going to do is add the present value of dismantling cost to asset side, and the corresponding liability will have the dismantling cost. Now the asset side figure is going to be depreciated every year. Liability side figure will go on increasing every year with the amount of interest. Because we have discounted now. So 40,000 must have been discounted and you are showing something like 18,000. So 18,000 as of today, but after 20 years, it should show 40,000. So 18,000 as of today, every year I will go on adding interest to it, so that at the end of 20 years, it will come to 40,000. Okay, so this means that liability increases by the interest rate each year. With the increase taken to finance cost in the statement of profit or loss. So interest is always a finance cost. It will come in the profit and loss. Let us look at this first illustration. If an oil rig was built in the sea, the cost to be capitalized is likely to be including the cost of constructing the asset and the present value of the cost of dismantling the asset. If the asset cost $10 million to construct and would cost $4 million to remove, so $4 million is your dismantling cost. It is your dismantling cost. I'll just write at the side over here. $4 million is your dismantling cost. Okay, so this particular amount of 4 million is not to be paid now. It is to be paid in future, but I have to make a provision for this. I have to make a provision for this, and therefore I will show this now, okay, at the present value of $4 million. So dismantling cost, present value of 4 million has to be calculated. Now, what they have given. The present value of this dismantling cost must be calculated. If the interest rates are 5%, the present value of the dismantling cost will be calculated as 1 divided by, I showed you the technique in the last lecture of AFM. 1 divided by 1.05 equal to function 20 times. Okay, equal to function 20 times. Whatever value you get, you multiply to $4 million. So tell me, 1 divided by 1.05, 20 times equal to function. Use your calculator.
Sir, I don't have normal calculator. I have scientific calculator.
You need a financial calculator. You need a simple calculator to purchase.
Okay, sir. I'll keep it ready by next class.
Yeah. So on the scientific calculator also, if you can calculate, tell me. 1 divided by 1.05 raised to 20.
0.37688.
Yeah, 0.37688. Now, if I take that figure and multiply to $4 million, it will come to exactly 1,507,558, 557.9.
Yes, sir.
So
Same. I got.
that is your present value. So present value
Yes,
of 4 million is $1.5 million. The
Yes,
total
sir.
to be capitalized therefore will be cost of the asset plus the present value. 10 million plus this 1.5 million. So the total cost of the asset is $11,507,558. Got it?
Yes, sir.
Now, this amount of $11,507,558 should be depreciated over a period of 20 years. So I will divide that by 20 and I will get the amount as 5,75,378. This is your depreciation amount. The depreciation amount is 5,75,378. This is the cost of the asset.
Yes,
Each
sir.
year, the liability will be increased by the interest rate of 5%. What is the liability? This figure, no? Which we showed. I told you one effect is add to the cost of the asset. The second effect is that this figure will come on the liability side, and each year it is going to increase by the amount of interest. So on this 1,507,558, if I calculate now 5%, it comes to 75,378. You can see this figure here. I've shown the arrow mark, 75,378. Okay. So on
Yes,
this
sir.
1,0507,000, you calculate 5% interest, that will give you this figure, 75,370. So what is your total liability then? Your total liability is 1,507,558 plus this 75,378. That comes to 1,582,936. This is your total liability at the end of first year. In the second year, on this 1,582,936, again you will calculate 5%. And it will go on till the 20th year. In the 20th year, this figure will become $4 million. Is it clear?
Yes, sir.
Subsequent expenditure. Subsequent expenditure is expenditure that you incur on the asset after you purchase the asset. Should it be added to the cost of the asset? That is the question. Now, for example, I conduct repairs on the asset. Should I add the cost of repairs to the asset? The answer is, it depends upon how the repairs are going to affect the asset. Is it going to extend the economic benefits? In the sense that it will increase the cash flow. If it is going to increase the cash flow, yes, it has to be added to the cost of the asset. Does it increase the productivity of the asset? Answer is yes, I add it to the cost of the asset. Does it increase the life of the asset? Answer is yes, I will add to the cost of the asset. But if neither of these answer is yes, then I will not add to the cost of the asset. Okay. So conditions are, it enhances the economic benefits provided by the asset. That means future cash flows increase, or productivity of the asset increase, or the life of the asset increases. Second, it relates to an overhaul or a required major inspection of the asset. Meaning that every period you have to conduct a overhauling of the asset. Best example, aircraft. Aircraft after a particular period of time, sometimes it is 5 years, some cases they take 7 years. So after every 5 years, an overhauling cost is incurred. That overhauling cost is to keep the asset in better condition. So all the worn out parts will be replaced with new parts. Because aircraft you can't take a chance, it is flying in the air, so many thousand feet above the air, above the land. So if there is any mishap, then so many lives will be affected. So after every particular period of 5 years or 7 years or 6 years, they do the overhauling of this. The overhauling cost is to increase the life of the asset. So it will be added to the cost of the asset. Third, it is replacing a component of an asset made up of a number of components. Again, example, aircraft. In aircraft, you have the body of the aircraft, the engine of the aircraft, the tires of the aircraft, the interiors of the aircraft, the cabin of the the pilot. You have the entire electronic console over there. So all these things are different components of the same aircraft. So one component is being replaced. Let us say the inside seats are being replaced. Then it is to be added to the cost of the asset. Okay. So enhances the economic benefits provided by the asset, or relates to an overall of the asset, or amounts to replacing a component of an asset made up of a number of components. Then it is to be added to the cost of the asset. Then the subsequent expenditure will be added to the cost of the asset. But if it is not going to do any of these three things, neither the first nor the second nor the third, it is a normal routine maintenance expenditure, normal routine repairs expenditure, then it will be recognized in the statement of profit and loss account, because it maintains, not enhances, but maintains. The words are different. Earlier I used the word enhances. Now I'm using the word maintains. It maintains the economic benefits originally expected from the asset. So then that will be a normal routine expenditure which will be charged to profit and loss. Okay, up till here it is clear. So
Yes, sir.
a piece of machinery has an annual servicing cost of $10,000. During the most recent service, it was decided to replace part of the engineering, meaning that it is going to work faster and produce more units of product per hour, and the cost of this replacement is 20,000. So 10,000 is what? It is annual servicing cost. It will maintain the earning capacity. So it is to be charged to profit and loss. 20,000 is going to help the asset work faster and produce more units. It will enhance the productivity of the asset. Therefore, it is to be added to the cost of the asset. Okay? Any doubts up till here? Anything that you have not understood? All points clear? Sure. We'll stop here for today. We'll continue in the next section. That is tomorrow on Monday, I think we are having the next session. Monday in the afternoon at 2 o'clock. Okay? So till then, keep revising. And if you have any difficulties, let me know. Fine?
Okay, sir.
Bye.
Yes, sir. Thank you, sir. Bye, sir.
Bye. Good night.